Trevor Williams is the chief economist at Lloyds Bank Corporate Markets, and he joins me now. Thanks very much for joining us today. This is the first time that a Treasury Secretary has attended a European finance ministers' meeting, and it has led some people to expect that big things are likely to come of it. Do you think that's going to be the case?
Unfortunately, no. I think that it's more of a gesture to show that the US is concerned about the events that are taking place in Europe, and your wrap from the US opening shows that markets are being affected by events that are occurring in the euro area, driven by concerns about the potential for a debt default in the eurozone.
Now, what do you think we are likely to actually get out of this? Are we going to get a kind of a communique at the end? What's the best we can hope for?
I think a communique probably is the best that one can hope for. These are economic finance ministers, after all. It's not a meeting of the ministers to make decisions about the kind of spending cuts and help which could really solve this problem. There is no easy solution, by the way, and hence it's just not solvable at this level.
Now, one practical thing that might be able to be sorted out is the Finland question. Do you think that there's going to be some kind of compromise here where Finland's going to agree to the debt deal without collateral?
I think they're going to have to. After all, the bill has to be passed across all of the Eurozone economies. It's the only one holding it up. And I think that clearly if they all were to ask for collateral, how could Greece provide it? It's impossible, and therefore I think the Finns are going to have to back down on this one, and their partners behind closed doors are probably all leaning on them now to accept some sort of compromise.
Indeed. Now, one of the other issues that has been raised, quite worryingly I suppose, is the European Financial Stability Fund. Is it big enough? Does it need more money at this stage? Is that something that's going to be addressed this time round?
I don't think it'll be addressed at this meeting. Again, it's an ECOFIN meeting. It's not at this type of forum that those kinds of decisions are made. I think the EFSF, which has not yet been ratified, which is still subject to, as the person speaking prior to my coming on was saying, Greece has to meet its side of the bargain as well, and it's increasingly difficult to do so when your economy is contracting at 5% per annum, and the tax revenues are dwindling away as well. So I think it's very difficult to see how the EFSF fund will be sufficient, never mind whether Greece can meet its part of that bargain.
Well, this brings us back, doesn't it, to the issue of Germany and how willing Germany is to stump up more money for all of this.
Absolutely. I think, though, if one did a simple calculation based on where German debt-to-GDP ratios are at the moment, 87% of GDP based on the Maastricht measure of debt-to-GDP effectively means if, say, Germany were to borrow another 250 billion euros itself to help out, it would push its GDP ratio up towards 100% of GDP. That's the kind of level, I'm afraid, that attracts the attention of rating agencies, and they start to question whether even Germany may have to be downgraded. And I think that that's the territory that we're now unfortunately moving towards.
Where do you see this going? I know it's quite a big picture question, but we are managing to kick the can a little further down the road here. But is there a point at which we can't just keep doing that?
Absolutely. At some point, a resolution has to be reached, and some sort of deal will have to be struck which reduces the burden of Greece sufficiently for it to generate tax revenues for people to believe that it can actually meet its commitments without recourse to further borrowing from somewhere else. That point, unfortunately, has not yet been reached. Hence, markets are still jittery, and they will remain jittery until they see quite clearly that the position of the fiscal path that Greece is on is a sustainable one.
No, we saw a dip in the euro, and then it came back a little bit again after the central bankers got together and announced their coordinated move this week. Where do you see the euro at the moment?
Well, I think that one has to applaud the euro because it's continued to perform as a pretty resilient currency. It's not done badly at all. One could argue where fair value is for the euro against the US dollar, and I would argue it's not too far from around the 120, 130 level. So at these levels, I don't think the euro is particularly weak. This begs the question, of course, of what would happen to the euro were there to be some further fears about what would happen within the eurozone, and I think that the direction would be clearly for the euro to fall significantly below the 130 level.
Just how low could you see the euro going in that situation?
110,
Really?
parity. Absolutely. If there were to be a real emergency, then I think those levels are not unmanageable.
Okay. Well, Trevor Williams, Chief Economist at Lloyds Bank Corporate Markets, thank you very much indeed for joining us and giving us your analysis on the dollar.